Ben Reppond. Welcome to my YouTube broadcast. Today is Wednesday, March 19th, 2025. Okay, I want to begin with our dashboards, and the market has been negative. You know that. It's been down for the last month or so quite a bit, and this last week was negative. Everything in the U.S., I should say everything, nearly everything in the U.S. is negative. The first screen I'm going to show you is the dashboard on what's going on with the 6 equity indexes and long-term government bonds. The 6 are the U.S., the Dow, S&P, NASDAQ, and Russell, and then the foreign indexes are EFA, which is developed markets, and EEM, which is the underdeveloped countries, and then TLT for the government bonds. So this is ranked on the left side. It is ranked from top to bottom based on where those are year to date. Now, to the right of the names, you will see a yellow box and a pink box. The pink box is the year to date. So in that box, ordered from top to bottom, is where they are. So this, to me, is interesting because we haven't seen this, I think, since I've been doing videos. We haven't seen one like this. Developed markets, number 1, by quite a bit. Underdeveloped markets, emerging markets, number 2, by quite a bit. And number 3, long-term government bonds. Below that, again, pretty big gap there. Below that are the Dow, the S&P, the NASDAQ, and the Russell. And then in the yellow box is what happened last week, and they were all negative by quite a bit, except for emerging markets and government bonds. To the far right, you see the dots, green dots or red dots. The green dots are above that moving average, and the red dots are below. And you can see again from top to bottom, the top 2, emerging markets and developed markets, being number 1 and 2. And they all 4 categories, the 20, the 50, the 100, and 200-day moving averages, those ETFs are above all of those. And then government bonds is above 2 of them. Everything else, U.S. equities, negative. The S&P 500, as you could see from the previous chart, not doing well. There are 11 sectors, industry sectors, and there are 4 moving averages. So there's a potential of U.S. equities of it being 44 common, dots. 5 out of the 44 are positive. And they are healthcare, energy, which has 2 of them, and telecommunications and financials. All the others are negative. They're below their moving averages. The only one that was positive for the week was positive by quite a bit, which was energy, a very defensive sector. All the others were negative, again, by quite a bit. Year to date, you've got 7 of them that are positive or slightly positive, and the remaining 4 are negative, some by quite a bit. So that's the picture. There are 5, again, I said 5 out of 44 that are positive. Last week it was 18. Now, you may think about, or if you're invested, most of you are invested, what should I do? Defensively, what should I do? Should I get out of the market? Should I buy bonds? Should I, what should I do? Well, and I have this conversation with some people, and when you have this much negativity in the market, it makes people think about that. Because is it down 10% or 11%? or so, and what if it goes to 15 or 20 or 30, because they all start somewhere. And I won't say that it couldn't do that. It doesn't feel like it's going to do that, but I don't know that for sure. But the problem with people, and I've talked to so many over the years who have gotten out of the market because of emotion. They're managing or want to manage or control their money with their emotions. And the very successful investor Warren Buffett says do the opposite. When people are fearful, you need to be greedy. In other words, you need to buy when they're selling and sell when they're buying. But selling out of emotion when things are negative, you can do it. It's your money. You can do that if you want to. But the problem with it that I found is that it's based on emotion, and people who do that usually do not have a method to get back into the market, because the method to get back in probably is going to be logical, not emotional. And so you're using emotion to make one decision and logic to make another. It would be equally as bad if you used emotion on both of them. Anyway, it's that when you see that much negativity in the market, and I'm going to show you a chart that will point this out, that it is negative. But I would say right now it probably has more of a chance of going up than it has a chance of going down further. But again, that's an opinion. Okay, so here's the S&P, the S&P 500. Now this is over a 2.5-year period of time. I put a line, an arrow, pointing from the beginning of that to where we are today. At the end, the far right, the upper right, you can see the decline. It has gone through the moving average, the 20-period moving average. This is one move equals 1 week. So that line looks to me that it is probably, I think it's a 3-week period of time. Maybe it's even a 4-week, but, excuse me. And then I put it on a bar chart so you can see that, toward the far right, there's a lot of red bars. And this last week is that bar at the very end of it. This is the NASDAQ 100 compared to, on a relative strength basis, compared to the S&P 500 over a 30-month period. So a relative strength chart. So you can see, it looks very different than the previous chart because you're comparing two indexes. And when it goes down, that favors the S&P. When it goes up, that favors the NASDAQ. So the S&P has been more in favor than the NASDAQ because it has been coming down. And that little tick at the very end of it shows that it is slightly down on a relative basis compared to the NASDAQ. This is a chart that I don't normally show, but I'm going to show it here because it shows you this is a daily chart, candlestick daily chart, that shows you the movement up or down over the past month or so. And at the bottom, I put this in because I thought it was interesting, is the volume. Now, Friday was a positive day. That's represented by that candlestick at the very far right. What was interesting to me is that is not the sign of a bottom. It typically does not look like that. So if the market goes up from here, my guess is it's what's called a relief rally, where it needs to let off some steam and go back up before it can go on down further. Because I say that because when you look at the volume chart below it, the volume is lower. I put a black arrow across there, and to just show you how many times the volume is higher, and then when it wants to go up, it is, I won't say it's anemic because it's not, but it's not as strong as the bars that took it down. What you want to see if the market is going to go up, from a volume standpoint, you want to see a strong move up from a volume standpoint, and when you particularly at the very bottom. If Thursday was a bottom, that Friday does not look like the beginning of a new bull market or a bullish approach going forward over, let's say, a period of months. Again, that's an opinion. Okay, growth versus value. SPY G, growth. SPY V, value. So these are ETFs on a relative strength basis, showing that when it goes down, it is favoring value. Value stocks are in favor. And when it goes up, it is favoring growth. And you see a couple of times, well, 2 or 3 times, where it's come down a lot, and those are periods where value is in favor. And then you have some times where it goes up a lot, and that's when growth is in favor. Usually it's one or the other. There are some other periods where it's not as decisive. It may go up a little bit or down a little bit. S&P 500 versus SPY versus small caps, the small cap index. IWM is the symbol. And you can see there's a little tick down at the very end. So last week, actually, that represents last week. The last week, the Russell was slightly in favor, causing it to go down a little bit. But you can see for, 2 or 3 months, probably at least 3 months, you can see it's been mostly on an upward move, meaning a large cap has been more in favor than small cap. Bonds, you can see where they are at the very end. They've come up, but now they've come back down some. And long term, over 5 years, not very good. And if you look at other bond indexes, AGG or IEF, they are all, or even the junk bonds, HYG, they're all going down. And so the dollar has declined. It was kind of leveled off this last week at the very end. You can see that. But for the last month or so, maybe a month and a half, you can see that the dollar has been in a period of decline. But overall, over this 4-year period, it is increasing in value. Gold had a good week. Gold and silver both had a good week. This is the gold chart going up to a new high, at least on an intermediate term basis. And yeah, so the strongest asset out there right now are precious metals. Silver had an even better week, and it's more of a choppy chart, and but you see the move up at the very end. Yeah, silver is definitely in favor, and I'll cover that a little more later. Bitcoin has been coming down and for the last couple of months, and you can see that. It's not showing any strength. I don't know why that is. It may be supply and demand, but it's not following the pattern of gold and silver. Okay, this is the volatility index, the VIX, and it shows volatility. Now, the volatility index on an intraday basis actually went up, I believe, to around 28. And I normally look at 24 as a benchmark. It went above that, but it settled back below that. I put a black mark there where it is today, which is a little above 21. So it's going up. It will take more downward pressure on the market for this to push on up above 24. Second week in a row, maybe third week in a row, Asbury 6, all negative, all 6 indicators. Relative performance of different asset classes, 2, which I've covered, emerging markets and developed markets are stronger in all 3 categories the last week, the last month, the last quarter than others. Others may be one might be favored stocks, one might, and then another period favor bonds. So there's not consistency on the dominance of one asset over another, except for those two, developed markets and emerging markets. And the U.S., because of what I'm covering, the U.S. is not looking good from a stock market perspective. This ranks other countries and regions of the world. Many of them, most of them, are stronger than the U.S. The U.S. is not stronger than one of them for all three time periods. So the ones that are stronger than the U.S. for the last week, month, and quarter are Chile, Brazil, Peru, Canada, Mexico, Italy, Germany, Spain, France, UK, Eurozone, Malaysia, Japan, South Korea, China, Pacific, Saudi Arabia, and Australia. This is a chart that I've been showing. It gives as good a light as I could for any country to compare the U.S. to over this 4-year period of time, and that's comparing it to South Korea. But even when you compare it to South Korea, or we could compare it to other countries based on what I just showed you, they wouldn't be as consistent as this. But during the last month and a half or so, the U.S. is weaker than South Korea, marked by the decline in that the line. Okay, gold. The spot price as of last Friday was $29.88, and that's an increase of 3% over the previous week. Silver, $34.31, a rise of 4.5% over the previous week, and the gold-silver ratio is 88:1. A monster box of silver, pure silver, bullion, and that is now $17,515. If you've been watching this for a while, you remember it wasn't long ago. This was around $12,000. So it has definitely gone up quite a bit. And that is a markup of 91 cents per ounce over spot, bringing it to a price of $35.03 per round. Times 500 gets you to the 17,000. Okay, the bears are in charge, okay, I think of it as tough love, taking care of the bulls. So the bulls have retreated, and I don't know when they're going to come out and when the market is going to go back up again. I do know, based on what I've seen in the past, that the market usually goes up when you don't expect it to. So there are people who are talking about that maybe we're kind of at a bottom here. I'm not going to say that for sure. We'll know in retrospect. We can look back and tell. But for now, the bears are in charge. Okay, thank you for watching. If you have questions or comments, leave them in the comment section below. And if you haven't subscribed, please hit the subscribe button. Thank you.